Hi everyone, my name is Dharmo Soejanto and I'm the Chief Investment Strategist at UOBAM Invest. It has been a difficult quarter to say the least, with all major asset classes down for the quarter. Global equities fell 4%. This is the third consecutive quarter of loss. The last time where stock markets saw 3 quarters of consecutive losses was during the global financial crisis in 2008. These show that we are truly in exceptional times. Bonds did not perform any better as US Treasury yields surged over the quarter. Some investors were hoping that the US Federal Reserve would pause its tightening. This did not happen, and Federal Chairman Jerome Powell, in fact, reiterated that the central bank would do whatever it takes to quell inflation, despite hits to consumers and businesses. As a result, global bonds lost as much as global equities for the quarter. Asian investments were more mixed. Asian investment-grade bonds were largely flat over the quarter, while Asian equities were down more than 10%. In China, worries about further COVID-19 lockdowns weakened market sentiment. The property market disarray that also showed little signs of recovery. The rest of the North Asian markets also came in weaker because of concerns over slowing economic growth and an overall downturn in the global technology cycle. The very conservative portfolio was down 3.4% for the quarter, mainly due to the drag from international government bonds and emerging markets government bonds. The allocation to money market fund helped to offset some of those losses. For the conservative and moderate portfolios, which both declined 3.5%, international government bonds, Asian equities, and emerging market government bonds weighed on performance. The conservative portfolio's allocation to money market fund helped to offset some of those losses, while for the moderate portfolio, allocation to US government bonds and emerging market high-yield bonds buffered performance as they posted smaller losses. Similarly, the aggressive portfolio suffered 4.7% loss as Asian equities and international government bonds weighed on performance, while the allocation to US government bonds and emerging market high-yield bonds helped relative performance. The very aggressive portfolio, which declined 5.5%, had additional allocation to global equities that further weighed on performance in comparison to the aggressive portfolio. Likewise, allocating to emerging market high-yield bonds mitigated as it posted a smaller loss. Over the longer term, we have increased our expected return for most asset classes as valuations have become more attractive. On the other hand, short-term volatility has also increased. So for now, we are reducing our equity exposures and increasing our high-grade bonds exposure across the portfolios. (2022) is a very complicated year for markets. We have had conflicting signals. Strong job market signals a possible mild slowdown, while the stock market is pricing a deeper recession. As such, we expect equities to be volatile and range-bound for the rest of the year before beginning any sustained recovery. For bonds, we are still neutral, but we are becoming more positive as yields climb and approach peak rates. We continue to expect the US dollar to be supported on the back of relative tighter monetary policy in the US compared to other regions. Chinese equities is trading at a significant discount to global equities, and we continue to see Chinese equities as being attractive. As always, we encourage investors to take advantage of the market weakness by dollar cost averaging and staying invested through these volatile times. Thank you for listening and for your continued support.